So allow me to welcome you all to today's event, which is entitled What Drives Capital into Emerging and Frontier Markets? And I think by the level of interest in the registration, I think this is a topic that is front and center for many of us in our activities in the different chairs that we sit in. My name is Laurie Spengler, and I have the privilege of being our moderator today. I'm really looking forward to the conversation. And I think before I introduce our panelists, just a word about why this topic is the focus of our conversation today. I really think it's just because it's unbelievably important. It's important because there's just an acute need for capital to flow and more capital to flow into emerging and frontier markets. I was participating in a conversation a couple of weeks ago, the Global Impact Investing Summit here in London, and the conversation around the SDGs and the progress we were making around the SDGs was quite sobering. And recently the UN has come out and said, we used to talk about $3 trillion a year to meet the global goals. We're now talking about $5 to $7 trillion a year coming out of COVID. And so the need for capital to flow to meet our global goals across the world is incredibly high. And then that need is particularly acute in emerging markets. We see a gap in the flow of capital to developed markets and emerging markets. We also see a gap between climate and social objectives as they play out in the global goals. We may talk a little bit about that. The second reason that I think this conversation is so important, and especially the perspectives we're going to hear from our panelists, is that even for those who express an interest in investing in emerging markets and frontier markets, there tends to be quite a gap between the expression of that interest and the flow of capital. And what we want to try to do from our panelists today is understand, how do you bridge that gap, narrow that gap, chip away at that gap? How do you actually identify some of the motivations for those expressions of interest, but really help people make then the determination to get the capital moving into investable propositions? Our conversation today is being hosted by Chemonics and the Impact Investing Institute. And the initiative is really under the rubric of a program called MOBILIST, which you can see on the slide here today. And the MOBILIST is a UK government program focused on mobilizing institutional capital at scale to achieve our global goals. Hence the focus in emerging and frontier markets, as I talked about. MOBILIST is looking across asset classes, but with a particular focus on listed products, which I think will be quite interesting as we tease out some of the aspects of listed products in our conversation today. Chemonics is a leading development consultancy firm that's been advising the UK government in the context of the research agenda for MOBILIST. MOBILIST has both an investing agenda and a research agenda, and Chemonics has been a partner on the research agenda. And the UK Impact Investing Institute is an organization that was launched in 2019 here in the UK that really tries to encourage investors to pursue impact in their deployment of capital. And I have got the privilege of serving on the advisory council of the Institute since inception. You also see the name of Intellidex, and that is a good segue for me to introduce our panelists today. We will have Stuart Theobald, who is chair of Intellidex. Intellidex is a research and consulting house that specializes in capital markets and financial services in emerging markets. And Intellidex has led some of the research under the MOBILIST research agenda that he's going to be sharing with us today to really be a conversation starter for our two investor panelists. We have Sarah Norris, who is investment director at abrdn, and she focuses within the global equities team. She's the co-portfolio manager of the Global Equity and Impact Strategy. And what I find particularly interesting about Sarah's background is that she started her career in development. And so she really brings to her work as an investor a perspective of development objectives and development imperatives. I'm looking forward to hearing from Sarah. And Greg Smith, emerging markets fund manager at M&G Investments. And Greg is both a fund manager and a PhD, who analyzes and I think chips away and challenges and maybe inverts some of the commonly held assumptions or misassumptions, erroneous assumptions about investing in emerging and frontier markets. And Greg has not only invested actively, but he's written extensively about what we can do to really accelerate the flow of capital to emerging and frontier markets, and look forward to hearing Greg's perspective as well. So those are the three colleagues we're going to have in conversation today. The format of today is that Stuart is going to kick us off. There are two parts of our conversation. We're going to be looking at what Stuart was calling top-down kind of allocation strategies around investor tables, and what are some of the impediments, barriers, and most importantly, solutions to expanding those allocation strategies to get more capital flowing to emerging and frontier markets. And the second part of our conversation will be more bottom-up, looking at what's happening at a market and a country level, and how do we navigate through some of those factors and challenges that place in market. And we're going to have Stuart kick us off for each of those parts of the conversation. And then Sarah and Greg and I will be in conversation around a few questions that flow from the research, and also importantly, lift from the experience of Sarah and Greg in their investing activities. We would encourage the audience members to put questions in the Q&A function. So please use the Q&A. We have someone curating that, and they'll be feeding some questions to me, and I'll make every effort to weave those questions into our conversation today. So we've got a little bit less than 90 minutes, looking forward to it. And with that, I'm welcoming all of you, welcoming our speakers. And Stuart, I'm going to ask you to kick us off.
Thanks very much, Laurie, and good afternoon or good morning to some of you. Really good to be with you. This is the culmination of what has been a 6 months project, working with the Mobilist team to really try and answer some questions about what it is that drives capital flows towards emerging and frontier markets. It has been a fascinating project in which myself and my team from Intellidex have learned much. Principally, it was done through a series of interviews. We conducted over 50 interviews with market participants, including asset owners like pension funds and sovereign wealth funds, various intermediaries, asset consultants, many asset managers, and tried to draw out the practice of investment decision-making as it applied to frontier and emerging markets, and complement that with data and literature to contextualize it. And we're bringing to you now some of those findings. We framed this in terms of ESG, and ESG was one of the important issues that emerged through the process of our research. But I must say that our research objective was to understand the drivers of investment flows holistically. So I want to start in this first section where we're going to look at the top-down analytical factors that lead to portfolio allocation decisions. And then in the second half, as Laurie indicated, we'll pick up on some of the bottom-up analysis, some of the features of markets themselves and issuers in emerging and frontier markets that lead to investment decisions. On the top-down side, of course, there are those typical top-down frameworks, overall portfolio management strategies that are developed by investors, and emerging and frontier markets have to find their place within those strategies, contextualized as well against the asset liability framework and outlook for the particular asset owner. Global conditions are major drivers of top-down analysis as well. And then increasingly, there is a role of ESG, which we can see as a top-down factor because it's essentially a governed process that integrates ESG analysis alongside your typical investment analysis in forming portfolio decisions and strategies. So I'm going to start with that top-down analysis and first of all, paint a picture. For many of our interviewees, there was a sense that emerging and frontier markets had a moment in the sun, and that really happened in the period roughly from the dot-com crisis to the global financial crisis in the early 2000s. Now, that was a period of significant outperformance by emerging markets, and you can see in that graph there that the MSCI Emerging Markets Index gave you roughly 100% outperformance on what you were getting from the developed market MSCI World Index. And at the time, there was a significant amount of interest that followed. This quote from one of our interviewees, I think, really captures it. If you go back 10 or 15 years, there were prominent frontier market themes, and people were raising funds to invest into frontier stocks. It was a massively fashionable thing. Every house from BlackRock to Fidelity was doing it, all the way down the spectrum, announcing we're launching frontier funds. And I put the covers of two popular books of the time, which were sort of household investment names, I guess, of Mark Mobius and Jim O'Neill, who coined the term BRICS, and then the next 11, and very prominent figures on the global stage, highlighting emerging market opportunities and really presenting the case for investment allocation to those markets. But if you fast forward to the period post the financial crisis, and particularly the period since the COVID-19 epidemic, you can see that that was not sustained. Indeed, there's been quite a significant underperformance from emerging markets relative to the MSCI world. And this has really affected the positioning of emerging markets and frontier markets within portfolio strategies. Now, of course, we know market expectations are about the future, but the historic data that these kinds of indices give us are used in portfolio strategy, and correlations and return figures are influencing the way asset owners are thinking about emerging market allocations. And our interviewees generally suggested that they expect to be downweighting emerging markets exposures. And many of the market expectations that you see from sell-side analysts prominently do have outlooks that are relatively negative on emerging markets against the developed markets. We've also, of course, had since the financial crisis a really long period of low interest rates in which yields have been very weak on developed market debt. And we've had a period in which the risk-on, risk-off decision framework has framed allocations to emerging and frontier markets. And there was a sense from many of our interviewees that this has meant that the specialist fundamental research on emerging frontier markets has largely been left in the shadows, that investment decisions are driven much more about perspectives from a developed market monetary policy side than a kind of focus on the markets themselves and the value that they might or might not be offering. So the result is captured in this quote. Unfortunately, the last 6 years have seen all of those funds close to the point today where there's probably only a handful left. And this interview is talking about specialist emerging frontier market funds. The biggest frustration of unlocking institutional investment into frontier market companies has been the lack of either trading liquidity or index inclusion. And I want to talk specifically as well about the role of ESG. Our respondents do use ESG significantly. Those who are specialist ESG managers, but also general emerging or frontier markets managers have an ESG process factored into their decision framework. And you can see here that many apply a country level screening process in what they're doing. And that can be either positive or negative screening. And many of the interviewees we spoke to used their own, often in-house models developed to either weight or set thresholds for different emerging and frontier markets and their issuers. And this was really being increasingly applied. And there was a strong sense that there was growth in the use of these ESG decision frameworks into investment allocation. But there's also a significant concern about what this means for emerging and frontier markets. And here is a quote that I think really picks up on that. In practical terms, on any scoring system, you end up scoring emerging markets poorly. That is deleterious for emerging market flows and is an important aspect that is going to be hard to deal with for development. Now, in this quote, what you can see is that models are being framed using data such as corruption perception indices, freedom of the press indices, labor standards, and so on. And those models tend to bias against emerging markets that are still developing and often don't have equivalent frameworks to developed markets. And as a result, the use of these models is systematically biasing capital back towards developed markets. And it's that particular trend that this interviewee is noting. Now, there are many nuances to this, to the way this functions in practice. There are tensions between the E and the S within ESG. Environmental data has probably been developed much faster and is really a developed market focus. And we see it centered in EU and other G7 policies and engagement strategies with emerging frontier markets. And as a result, the E tends to be dominant in how ESG is applied and thought of in emerging markets. And often the emerging and frontier market need is far greater around the S, and issues like domestic legitimacy of foreign investment come into play when domestic markets perceive foreign investors being much more concerned about the E and the S. And here is a quote that kind of illustrates that data problem. If I invest in a renewable producer, I can tell pretty tangibly how much carbon is reduced. In the social space, you start talking about education, health, and sanitation. It is harder to measure and quantify, which has made it more difficult to invest in such projects. So you are seeing the S being a need in emerging and frontier markets, but the practice of global fund managers being much more driven by the E. And this has a risk of sort of delegitimizing foreign investment in emerging markets. The information asymmetries, of course, many data providers are attempting to solve for these. We asked our respondents where they got data. Many rely, of course, on their Bloomberg terminals. Many use in-country analysts. There are ESG reports that they access and other data providers like Refinitiv, Sustainalytics, MSCI, and so on. So there is a plethora of different data sources, but still the sense that there are generally poor data sources on emerging markets, and that no indices really capture the notion of additionality. So of thematic investing to bias capital towards issuers who are delivering enhancement on SDGs or other measures of environmental and social outcomes. And I just want to end off with this quote from one of our frustrated respondents who said, "I would like some mandates that define sustainability as achievements on the Sustainable Development Goals. We think we can run quite a large fund that has that mandate and goal, but it's difficult to develop the fund and that mandate in the current context and the way ESG is perceived and the way asset owners are factoring ESG into their decision-making." I'll pause there and hand back to Laurie to go through, to introduce the panel discussion. But just to say that the full report, which really goes into detail on these findings, will be available to everybody as soon as this call concludes. So please do pick up that full report, and I'll be back with you a bit later to talk about some of the bottom-up issues our research identified. Thanks, Laurie.
Super. Thanks so much, Stuart. And thanks for confirming that the research will be available, because we had lots of questions in the chat as you were speaking, expressions of interest in digging into some of the information you've just shared. So thank you so much for that framing. And I'm gonna ask Greg and Sarah to come onto camera so we can see you both as we start our conversation. And I think before we kind of get into the specific findings of the research, and most importantly, how the two of you as investors are navigating through some of the challenges Stuart shared, I'd like to ask each of you just an opening question to introduce yourselves a little bit more than I did in the kind of one-liner framing, but more importantly, how you think about emerging markets and frontier markets and the opportunity set. So maybe just position yourself and your institution, Sarah, in the context of the geographic focus of our conversation, and then we'll dig into some of the challenges. So Sarah, please to you.
Definitely. Thank you for having me this afternoon. So as Laurie said, I run a global impact strategy. And the way we think about impact is very much environmental and social, having that twin ambition. And we don't believe that you can focus on one without the other. Social and environmental issues are holistic in nature and often multidimensional. You'll have social implications from the environmental crises when you think about extreme weather events and where they're occurring, the demographics they're affecting. And similarly, you'll need education and social issues and social solutions to tackle climate change. So we're positioning as looking at them both. And when we think about impact is really trying to address an unmet need. And another way to think about unmet need is unmet demand. And often unmet need sits in emerging markets when we think about those social issues around healthcare, education, access to water, food. I mean, they're pervasive, but the opportunity set is significant in emerging markets. And so it's interesting that some of the findings were that there's not enough attractive opportunities, and the solutions that we're looking for do fit perfectly in an emerging market context. We are slightly constrained awareness, and we can be unconstrained, but But that's maybe where some of the limitations in allocating more towards emerging markets come from our perspective, not so much around the attraction of the opportunity set.
That's fantastic.
Greg?
Oh, sorry, Sarah. You're breaking up just a little bit, Sarah. Can you hear me, Sarah?
Yeah, I can hear you now.
Okay, great. Sorry, I didn't mean to cut you off. You were just breaking up a tiny bit.
No, that's fine. I was going to say Greg might have a different perspective, being a specific EM investor.
But I think what's really helpful, Sarah, thanks for teeing us off, is that, you know, given a global perspective, how you're looking at the opportunities, you're really being pulled from your perspective into the size and scale of the opportunity. And I really appreciate your framing of the E and the S. It's not or, but it's the E and the S, and actually the integration of those dimensions that you see in a number of the strategies. So that's really helpful as a kickoff. Greg, over to you. How do you introduce yourself, please, and M&G, where you sit and how you think about emerging markets and frontier markets?
I'm a fund manager on the fixed income side, so my primary focus is listed debt, be it sovereign or corporate debt. But as a firm, we have mandates that cover equities in emerging and frontier markets. We have private investment, as well as we're an asset owner as well as an asset manager. But just for me, the domain of emerging markets and frontier markets, the first thing is quite a broad number of countries and quite ill-defined across asset classes, and what you include is really a choice. And for us in the emerging markets, you've got about 90 investable countries in fixed income, and one end of the spectrum, you've got countries in Eastern Europe, say Hungary, say Serbia, say Poland, that are very similar to advanced economies, developed markets. And at the other end of the spectrum, you've got very small frontier markets that have taken a step to issue a Eurobond or have a single stock listed, and they have you know, and those countries are massively different. And so within that universe, that we're sort of, at least in my funds, we're EM dedicated. So we've always, that's what we do. We look for opportunities only within emerging markets, and I think we've had a massive shift and growth of the asset class. And as Stuart points out, the focus was on the BRICS in the years up to the global financial crisis. And one thing that's occurred over the last 10 years is an expansion of the frontier. There's many more countries in the main indices and many more investable countries in terms of listed securities over the past 10 years. And that story between, say, 2010 and 2019 was of increased bond issuance, but that's come under pressure, certainly within the pandemic era, and particularly so this year as US rates have increased, and there are real challenges ahead. And I'm on the upside, though, we do have the opportunity of trying to make this market access, this borrowing, this equity listing better, with much clearer specification of what emerging markets or frontier markets are going to do with the proceeds, and in that is ESG, and people are looking not only to make a financial return but also do something positive, and that something positive is now under a sustainability badge. And whether that's poverty reduction, dealing with the climate emergency, helping achieve the Sustainable Development Goals, it's all quite varied, but it's sort of at the moment packaged under ESG, which is really something that's been evolving over the last 30 years with its roots in ethical investing, etc. And I think where we are now is that we've made a crucial and positive step, but we've got a huge amount of work to do to improve this opportunity for emerging and frontier markets to access capital.
Fantastic. Thanks, Greg. I think we're going to try to get into in the conversation a little bit of the response to some of the research barriers. I mean, some of what Stuart shared is quite sobering about emerging markets and what's getting in the way for allocators, and then really learn from your experience, because both of you are putting capital to work in many of these markets. So Sarah, I'm going to start with you. If we think about or listen to the research and what Stuart shared, what resonates with you, and what maybe do you have a slightly different view on based on your own experience? I mean, we talked about returns, he talked about ESG, he talked about information asymmetries, and it's not preventing you from pursuing investment activity. So what resonated about that research, and what would be the points of emphasis from your perspective?
I think I definitely emphasize the data gap within ESG. Most people on the call are probably sick of hearing asset allocators talk about or bemoan the fact that MSCI, Sustainalytics, all these rating agencies, they have woeful coverage of emerging markets, smaller companies, they're backward looking, and it requires being closer to the companies that you're investing in. It requires quite a lot of bottom-up analysis. I don't think you can screen for ESG, certainly in emerging markets. I don't think you can really screen for impact. You have to be able to talk to the management teams, and you have to look at companies in context. You can't just screen out a country in its entirety because you're missing out certain opportunities. We've got numerous countries and companies represented in the global fund and in emerging markets, some of which are EM holdings were best performing over the last few years. So the returns opportunity is there, but you have to be discerning. And I don't think you can apply a screen and then pick from what's left. It requires that manual intervention. So ESG is kind of front and center for me, and that was really what kind of came out of the research process. But I don't think that the returns aren't there. I think you just have to hunt for them a bit more when it comes to the opportunities. And as I said, in emerging markets, unmet need is unmet demand. So there's significant demand opportunity if a company gets it right.
So Sarah, that's fantastic. Let me ask you a follow-up question. I'm thinking about an allocation approach, a strategy, how you, given what you've just said about the need to go beyond country level or macro level screens, which will unintentionally exclude a vibrant universe of opportunities. How do you develop then your allocation strategy? Is it much more of an iterative process? Do you prioritize? What do you prioritize? Recognizing what you just said, that you've got to unearth the opportunities and have that interaction. So how does that play out to your allocation strategies?
We prioritize unmet need. So we use the World Bank database and other international agency databases to say, what is an unmet need in a specific country? Is that below global averages? And then can we identify companies that are providing solutions to that unmet need? So it's much more, it's a screen of sorts, if you want to use that word, but it's a positive screen rather than a negative screen. We're not excluding, we're actually trying to hone in on where are those demand opportunities, where are those unmet need opportunities, because coming back to the point around additionality, we're looking to measure the impact these companies are having in a specific country. So measuring the impact their products and services are having on that data and on that unmet need.
So like you used healthcare, education, you used several sector reference points in your introduction. So you would be looking for some of those unmet needs relative to that delta you talked about, and then proactively pursue opportunities. And are you saying then, Sarah, as you're hunting for those, you're not necessarily deterred by the fact that the country itself may have a challenged rating by any of the indices we might look at? This bias, this emerging market bias that Stuart referenced, how do you deal with it? Do you just ignore it? Do you put it to one side, or it is just one of many factors in your pursuit for the opportunities?
It's one of many factors. I mean, we will have certain restrictions on specific countries. At the moment, Russia falls into that category, but they tend to be company driven and top down as part of our policy, rather than trying to take a specific approach or a scattergun approach, I guess, and screen out specific countries based on a ratings agency. It's much more strategic direction in our economic view of some of the risks. And we have internal assessments of, I think to the point made earlier around freedom of the press, women's rights, healthcare, and that all feeds into a much more iterative process, to use that word, and much more case by case rather than a blanket screen.
Yeah. And so Sarah, does that have implications for your human resources, the level of resource that you're applying to this undertaking?
Yeah, well, we've got a huge emerging markets team, and then we've got a huge ESG resource. I think we've got over 50 ESG analysts just dedicated to the ESG side of things, as well as kind of our macro. And then we've got embedded financial analysts in most of the regions that we cover, sitting across Latin America, Southeast Asia, and the like. So it comes back to, you need to be close to these companies, you need to be embedded in these regions to overcome that information gap and that information barrier.
I got it. Thank you. Really helpful. Thanks so much. We're going to come back. Maybe you can share an example with us, but I'm going to switch to Greg for a second. So Greg, a similar opening question, what about the research really resonated with you, or what might you have a different point of emphasis in your own experience? Oh, you're on. I can't hear you, Greg. Let's see.
Great. I think that's better. So first of all, I just really enjoyed reading the report. It's well written, it's clear, and it cuts to the chase. And I think just the title in itself, I think too many, the challenge of driving investment flows to emerging and frontier markets is an excellent place to start. You know, too many reports of this nature focus on other problems like solving a debt crisis, etc. But really, this is the crux of the matter, and how we can increase investment flows. And again, doesn't matter what you're trying to achieve, SDGs, poverty reduction, dealing with climate emergency, that this is the huge challenge that we face. And particularly at the moment in weak markets, you've got a large exercise of essentially the multilateral organization sort of beating the doom drum of articulating challenges and problems all the time. And we get this sort of pendulum that swings from encouraging private finance to achieve the sustainable development goals to everyone should just give up on their investments and forgive immediately. And this sort of swings every few years. But the truth is, to achieve these goals and make development progress, ensure that there's sufficient money for climate adaptation and mitigation, we're going to need a flow of capital. And that has to at some point come from this 85 trillion pot of money that the report articulates. And it is a scary amount of money that's needed for emerging markets and frontier markets, but 2.6 trillion as the report, that's not a huge percentage of 85 or whatever number you pick as the investment universe. It is doable. And so I think there is an importance, particularly in tough markets like now, is to take that medium and longer term view and work out how we can ensure that there is this flow of information, a flow of capital, and in return there's a flow of information, because the difficulty on this side is to credibly say, as part of the industry, I'm running an ESG fund. And to do that, you can't just say you're doing it, you need to prove you're doing it. And if you don't, it's one, it's letting down your clients, and two, it would, you'd be fined by the regulators. So there's a lot of pressure for people to do ESG properly. And to do ESG properly, you've got to be rigorous. And I think once that comes in with the current regulations, you do sort of, it tips you towards maybe excluding those countries. What about the reputation risk? What would the headlines of the newspapers say if we were investing in this country or this company? So my worry is that you become too risk averse and you end up only investing in Sweden. But what we need is something that gets the regulation right, so that people are credible in what they're doing for ESG, but also allows people to take ESG risks to invest in countries that are making progress. They might have a low score for social, they might have a low score for governance, but if there's some way of showing that there is momentum and progress, that can be rewarded with a flow of capital, then I think that's really important. And for a lot of the smaller countries, what probably binds more than the availability of money is the absorption, the ability to use it well. And I think wherever the market goes in the next 5-10 years, it's going towards a clearer use of proceeds, sort of defining better what you're doing with that investment, probably with an ESG badge as well, but just better articulation of what this money is being borrowed for or raised for. So the report summarizes these issues very well, and it's interesting to see what all the different people interviewed have come up with. But I think the enormity of the task is there. There's no there's no sort of getting away from that about how much work needs to be done. But I remain quite positive in that what's been done over the last few years, and it's amazing really, like despite the pandemic, despite the challenges, how many new green SDG social bonds there are, and so as that asset class grows, it will make it much easier for a fund to say they are buying a particular asset that fits with an ESG agenda, because I think when it comes, there's a huge amount of work to do, and it's interesting to hear what all the work Sarah's doing and her team. And I think when you're dedicating this space, you've got a huge number of people, huge number of analytics, but how do we get the marginal investor in that wants to put capital to work, that hasn't got 30, 40 people to do that? And maybe that way, the flow of information, it needs to be made easier for them. And I think that's where the report makes some very good suggestions and recommendations on helping solve data gaps and allowing debt management offices, corporates to sort of push that investment to bring more people in, because it's very clear at the moment in these markets that the amount of EM assets is too big for EM dedicated, and hence the recent sell-off. We need multi-asset, we need crossover money to come in, but for them to come in, we need to make it much easier to credibly say I'm investing in an ESG fashion in country X or this company. And I think there is a lot of support needed to particularly the poorer countries where the quality of debt management, the quality of data isn't so good.
Right. I think fantastic points, Greg. Thanks so much. I mean, I have a couple of just follow-ups. One is on the temporal horizon, because you made that point at the beginning, that kind of more of a medium to long term, and Stuart's research certainly highlights that if people take a very kind of a slice of a few years at times, you can have a bit of a dislocation if you look at emerging markets on the returns point of view. So are you finding that for investors who are really committing to thoughtful and developing thoughtful allocation strategies, are they modifying their temporal horizons? Sometimes they can, sometimes they can't, based on their own constraints. But I'm curious how people are coming at that temporal point that you highlighted. And the second thing I'm interested in, I personally share your view that there should be a positive association with progress. So if the trend lines are going in the right direction in the performance indicators, I mean, the emerging market scenario should be noted for that. And we don't see that from any of the rating agencies or any of the approaches. And do you see any movement, any traction to begin to have that approach, or is that still very much investor by investor? So those are my two follow-up questions.
Yeah, the markets are not good at long term, and that's the markets are pretty good at medium term, and they're very good at short term. What's happening this month? What will the Fed do this week? What will happen in the Russia-Ukraine conflict next month? And so it's difficult sometimes for the market to take a step back. And I think that's what ESG does. And, you know, the big difference between the G, the governance, and in my view, political risk, which has been well covered. Political risk covers the next election, where governance is these long-term changes, quality of public financial management, control of corruption. So we're bringing in a longer-term lens already with ESG, which I think is a positive. Mm-hmm. So even when we are in situations like this, you're trying to take a longer view, and I do see an improvement in the credit agency's report with looking at what ESG factors are material. But I think for me, the role of the credit agencies is to look at probability of default in debt. That's what I want them to do, and I don't mind, in a sense, risk if there's a high risk premium, you know, and thinking as a fund manager, if and especially as an active one, if that might be an opportunity. Mm-hmm. Being able to do a deep dive, find out and make it and take a view. So if the country risk is high but the returns are there, then it's of interest and an opportunity. But on the flip side, if I think like a sovereign or a corporate, I want lower cost of borrowing, obviously. I want lower costs of raising capital. So that's why the work needs to be done. And I think at the moment the challenge is that, you know, the report talks about some of the constraints, trading illiquidity. You know, it's very difficult to buy and sell these assets when you face outflows or difficult times. And so that's a challenge about people are avoiding duration at the moment. They're worried about taking on illiquid bonds or do things that are difficult to buy or sell in tough markets, and so that's a challenge. And that's particularly the case for listed assets that fall outside these main indices. So one of the things in the report is to help augment and improve the indices, which is fantastic, and that might in turn help some of the liquidity.
Great. Thanks, Greg. Thank you. That's good. I have two questions from the audience that I want to ask you. Sarah, I think I'll kick off with you. There's a question from the audience about human rights and other government level challenges, and sometimes the places that need the capital the most, where there might be some really interesting investable propositions, get caught out on the screens because of human rights violations and other government related issues. I mean, recognizing you said you're not stopped by screens, but they are a factor. How do you navigate through that set of challenges? And the second question, I'll just say it now, and Greg, I might ask you to kick off on it, is what is the role of DFIs, development finance institutions, in thinking about the mobilization and the effective flow of capital to emerging markets and frontier markets? So Sarah, over to you first.
Well, I think companies themselves can be huge champions of human rights and really affecting change in a specific country, but there is that natural tension between a country's policy or approach or reputation on human rights and then wanting to invest in a company that could transform it. And there's no right or wrong answer, to be perfectly honest. I mean, we internally look at state-owned enterprises, and we have a list of countries where, to Greg and yourself's points around improving trends or deteriorating trends of how a company is, how a country is progressing on human rights and several other factors. And if a country is on a deteriorating trend and below a threshold, we can't own state-owned enterprises in that specific country because the risk outweighs the rewards, specifically from an ESG perspective and that reputational damage. But if you wanted to invest in a country like China, where there are questions over human rights practices, certainly in certain regions like Xinjiang, but when we think about the unmet need around climate change and environment, and we're looking at companies that are upgrading their grid networks to allow more renewable energy, you do have that tension. And for us, it's looking at that trend and that improvement and making sure that we have enough analysis and enough facts to support our thesis that the country itself is improving, and then the company, where we can do even more work and we can do more due diligence on how are their human rights policies, what are their labor laws and policies, and how are they enforced, how do they treat their employees, and trying to agitate for change from the inside as much as we can do as an investor. Because can you agitate for change in a country at a political level? That's really difficult as an investor, but potentially you can at a company level, and that will have a knock-on implication.
Fantastic, fantastic. And what I appreciate you keep reminding, Sarah, is don't let the country level screen take you out of the consideration set. It's a relevant factor, but you're looking beyond that into the opportunities in the country. So it's really, really helpful. Greg, can you talk about the DFIs, the role of DFIs, and how do you see that as a relevance in thinking about emerging markets and frontier markets?
Yeah, their role is absolutely massive. A force for good, and I think from a global public good perspective, the data they provide. If I look at the way we monitor ESG trends, how many of those come directly from the DFIs, that provide them on a regular basis, that we couldn't do without that data flow, be it macro, be it on social, be it on governance indicators, and the reports for the hard to reach frontier markets. There's a pretty good coverage of international media and investment bank reports, but there are huge gaps. And if you want to invest in a niche frontier market, one of your first port of calls is often DFI reports on that country, or where and trying to get information and things. And as a convener, the conferences they hold in Washington and other places are very good ways of getting access to governments and to get information and to get ideas. So the global public goods, the convener, and then the concessional financing or the emergency financing in troubled markets. And I think the role of the IMF in 2020 was just incredible in terms of rapid financing. So the way they work is really important, and I think they can play a role as a catalyst for investing, particularly in climate adaptation and because they'll do the due diligence and because they will do some assessment of impact, that will help that marginal investor I spoke about earlier to get involved. But I think the challenge we have is how do we get to scale? How can we get, you know, more money in a sense raised and invested, because I think there's simply not enough, particularly when we look at the magnitude of the SDG challenge and the magnitude of the climate emergency challenge, and also on the other side of the coin, how can that money be absorbed and spent well? Because we don't want just one round of this. We can scale up and the money can be all spent, but we need a lot of work to ensure that the money is invested well. So in rounds 2 and 3, more money will follow. So they've got a huge important role, but they are stretched in many different directions.
Right. No, very, very helpful. And I mean, in full disclosure, on the board, I'm on the board of one of them, VII. So I appreciate the commentary. And I think you're right about data, information flows, also the kind of progression of the investment proposition into the maturation process. I mean, I think the efficiency point is very well taken. And how do we get more throughput of some of these deals, particularly where we have institutional investors and DFIs around the same structure. So I think that those are well taken. One last question before we go back to Stuart, FX risk. We have a question from the audience. How are you thinking about managing FX risk at a portfolio level or an investment, a deal level? Sarah, first to you and then to Greg.
Yeah, from a portfolio level, we don't hedge. We look at FX risk just in the context of the other holdings, and you make a judgment just like you would when you're building a portfolio. Do you want 10 companies with Brazilian exposure, or do you want to perhaps diversify that and have exposure across different emerging markets or different frontier markets and blend in developed markets? So again, I seem to be repeating myself, but it's one input, one factor into the decision. We've chosen not to hedge, and it's something that's a consideration, but it's also not a excluding factor either, as long as we're comfortable with the currency risk.
Fair. Thanks, Sarah. Thanks. I mean, and let's remind people you're looking at equity strategies. So I think that's also to be, I mean, we haven't really teased that out. We just said at the beginning, and I think that's an important point when you look at FX. Greg, being on the fixed income side, how do you think about currency?
Yeah, and again, the huge range of emerging markets, you know, from countries very like developed markets to the other end of the spectrum. So, you know, it depends on the markets. I think, you know, sometimes we will want that FX risk. We'll want the potential returns that might go with getting a strategy right. Other times we might have a clearer view on, say, interest rates or something like that, and want to hedge the FX risk. And then it depends on the country, and you've got a cost, you know, so you've got to, and the cost of hedging varies massively between countries. So you just got to look at the scenario itself and see whether that cost of hedging is worth it in itself. And that's something that can improve. And I think one of the things sort of written into the report is this, you know, identify opportunities to develop local markets. And any World Bank report of the last 30 years talks about deepening and developing local markets, be it regulation, be it opportunity. And it's a huge task and an important task, but there's a whole lot of work that needs to be done. And, you know, the easier hedging becomes, the cheaper hedging becomes, then the easier it is, you know, that again, that marginal investor that likes the commercial opportunity but doesn't like the FX risk can come in. So we've got a huge amount of work to do there, as it varies massively across different countries.
Yeah, no, fair. Thank you. Very fair. And I think, Stuart, that's a perfect transition back to you for some of the bottom up considerations as we think about what's happening at the market level and the issuer level. So, Stuart, I'm going to invite you to give us an insight into the second part of your research to stimulate the conversation between Greg and Sarah.
Absolutely. Yeah, thanks. It does indeed introduce some thoughts from the bottom up, and some of the conversation so far has touched on several of these. But we've talked about asset allocation decisions from the top down, from the perspective of developed market allocators. But the bottom up is just as important. And he has a quote that I think introduces one of the problems that one faces from a global market perspective. I've had funds where I've had to give back the cash to investors. We just couldn't find the assets with the money we'd been allocated. And I think this gets the nub of an asset allocation decision. On one hand, having to face up to the reality of what's available on the ground to deploy capital into. And the bottom-up perspective really focuses on that. And I want to just look at it from 3 levels. The country level factors. Now, typically when we think about bottom up and top down, country level is a sort of macroeconomic perspective, but in a global EM strategy, country level can in fact be one of the bottom up factors. Are there pull factors that country and evolution and change, or indeed push factors from trends at the country level? And I think that emerging market funds in general, and our panelists can perhaps comment on this, do have more latitude than their developed market counterparts in terms of investing off benchmark. So those indices that try to capture emerging markets often find it very difficult from a liquidity perspective, from a range of scope perspective, to capture the investment strategies that fund managers would like to deploy. So there's usually more scope to invest off benchmark, and that really opens the world very wide for identifying opportunities quite widely. And for those fund managers, the information asymmetry problem is also part of their competitive advantage. Specialist emerging market fund managers develop the skills and sources of data and insight to be able to overcome what would otherwise be a major barrier to investing more deeply. So even though we've talked a lot about the importance of getting data right, improving data flows, and that really is important, and I think all fund managers would welcome improvements, it is also the case that one of the reasons fund managers can identify alpha, potential upside in emerging markets, is that they solve for some of the data challenges that other investors face. Greg touched on this, the importance of domestic market regulation and development. One of the things we show in the report is how different asset classes have grown as a proportion of the overall investment universe. And you find that in fixed income, emerging markets have grown their market share of global issuance. And that's, I think, a feature of the success of DFI support to emerging market governments to enable them to build the infrastructure to become issuers in the global capital markets. The same is not really that true on the equity side. So emerging market equities market share has trended rather sideways. And I think that illustrates that the DFI focus point has largely been at sovereign level and has largely been on the debt side. And we haven't yet solved some of the issues that face equity issues in building that side of the market. And I think that's where asymmetries of information, the importance of understanding market dynamics. It's not only the information that issuers provide you, but what domestic capital markets themselves also can provide you, just in terms of trade flow and volumes and so on. And that can sometimes be a frustration for market participants who are sitting offshore. There are, of course, important features of domestic markets and how they're regulated and the political risk that comes with them. I think that an unfortunate exemplar that I'll mention is the experience of investors in Nigeria, which at one point was a very exciting frontier market for foreign investors. And that changed really from two episodes. One was in 2015, and then again in 2020 at the start of COVID, where Nigeria suspended the convertibility of the Naira, which means investors couldn't exit the market. They couldn't realize their proceeds. And that, if you're a collective mutual fund manager, is really difficult to have to say to your clients that you need to withhold their liquidity. And that has caused significant difficulties. One of the interviewees had to wind up a large Africa specialist fund simply because of that Nigeria experience, that all of the investors, and it was a fund that was widely invested across Africa, but because of the Nigeria experience, their clients had lost confidence, and the fund as a whole was forced to wind down. So there are examples of market infrastructure, regulated and political behavior that cause significant issues for foreign investors that have to be managed. And then just to focus on the data gaps that exist around the issuer level, there is the traditional data, the kind of data you would rely on your Refinitiv or Bloomberg systems to obtain. And that can be difficult in some markets. You'll find a market will, something as mundane as their website going down means you no longer have any daily closing prices for that market. Also at a sovereign level, there is challenges around the quality of statistics being provided and the frequency it's provided. The same is true of firms as well, and equity issuers. Now, to go back to the ESG theme, this is exacerbated by ESG demands. And there are many investors who are attempting to apply ESG models that require certain data from issuers that they simply can't obtain from frontier and developing market issuers. And so the data gaps that were there already are exacerbated by the needs for ESG. And this is despite the traditional bottom-up. Normally when we talk about bottom-up, we talk about valuations and the factors among issuers that demand that they're worthy of investment. And it's certainly the case that emerging markets offer many positive value metrics when you look at PE ratios and dividend yields and so on. And we often don't talk about that enough. I think one of the frustrations when it comes to indexation is that an MSCI emerging markets index, for example, is over 50% East Asia, and China alone is over a third of the index. And that tends to drive performance of that index. And globally, we tend to focus on that index performance when we make judgments about emerging markets, but scratch below the surface, and you have very diverse and divergent sets of countries, countries that have high natural resource exposure versus countries that have high tech exposure and so on. So really there is a wide universe and different valuation metrics to be found within that universe. And I think for an emerging markets fund manager, there is some frustration that the emerging markets label is sort of applied indiscriminately without recognition of just the diversity that exists within it. Let me finish with just this quote that goes, I think, to the point about the importance of developing local markets. If you have anything, you have to build your local market, your local pension funds and savings culture, because until you've got that, you shouldn't be worried about the billions of dollars waiting to come in. That money comes in and out and is not there to stay. So the importance of developing local domestic savings and investment industries so that there is diverse investment motivations, there is a confluence of wants between local investors and foreign investors that reduces the political risk facing foreign investors, and there is just more liquidity available in the market. That can be really important. And I think part of the conversation, and Greg, I think, has hinted on this as well, is that one has to think about using global capital to crowd in and stimulate local investment and local investment market development. And I will pause there, other than it's the last moment I have the microphone to just say a note of thanks to the Impact Investing Institute and to Mobilist for a great opportunity to work with you all, and to also thank my team at Intellidex, who did lots of hard work on this report. And please do get hold of us if you want any further engagement about it. Back to you, Laurie. Thanks.
That's super. Thanks so much, Stuart, and a reciprocal thank you for the research that you have produced. I mean, you can see already from the reactions, both the general audience and from Sarah and Greg, very cogent, clear, cuts to the chase. And then also people should read it because there are some really good suggestions that you're making, particularly on that information asymmetry we talked about in the first part of the conversation. So thank you for that, Stuart. And feel free, if you wanted to make a closing interjection, you can do so at the end of the half hour if we have time. Greg and Sarah, if you can come back on screen, I want to kick off going to 2 points that Stuart emphasized. Sarah, I'd like to direct I mean, you can both feel free to comment, but I'd like to direct as an opening the domestic capital markets question to you. And we did also get something from the audience on this very point. So what are you seeing in terms of domestic pools of capital? And is that a factor at all, for the reasons Stuart mentioned, influencing whether you might be more enthusiastic about deploying to a particular country or not? And then Greg, the question to you to lead off with is on this, the kind of what it really is now a gross label, if you will, of emerging market and frontier markets, as you've written about and spoken about. It just covers too much diversity and differentiation. And what are your thoughts for developing, whether it's a segmentation approach or other delineation approach that's more effective in making those capital decisions? So Sarah, over to you first, and then Greg.
So the domestic capital market, the depth and development, it 100% will affect the attractiveness of an emerging market or a frontier economy. I mean, it's something that we consider, but if I'm honest, we haven't found the perfect way to influence it. We're certainly looking at different factors, but it's still a work in progress, if I'm honest. I don't have a perfect answer, and I think that's what the report highlights. You've got some suggestions, and you've obviously got a clear need, but with regulation, with the current restrictions that come with that there's no perfect solution at the moment, certainly from an equities point of view. I don't know, Greg, if you've got a different view from fixed income, but it is something that we struggle with. There's that tension with a clear need and wanting to participate, but also having certain limitations around market access, for example, and some of the issues we have opening a market because of their concerns around custodians and some of that capital allocation and preservation.
No, it's fair, Sarah, and I know it's a complex consideration set. I do think, and I might just posit that I think it's another area where the DFIs can be helpful, and compared both in terms of literally on a deal by deal basis as we're building that track record and aperture of participation, but also in the regulatory environment as well. So direct with domestic pools, but also in the enabling environment. So I think that's another shout out for their roles and contribution. Greg, how do you want to tackle the question about diversity within the broad label of EM and frontier markets?
Yeah, I think we're active investment. So as Stuart pointed out, we're off benchmark is really appealing to us. We look for opportunities in many different places, be it from corporate, sovereigns, local hard currency. Some of them are difficult to scale, obviously, because they're smaller and potentially more illiquid than the larger listed securities in the indices. But I think if we look at different across the industry, so we've got a very fast growing passive investor dollar coming in to these funds, and so that money will only go where the benchmark is, because it won't look further, and so being able to expand, augment, offer new types of indices is really important for encouraging that. And again, going back to this point about the median investor who doesn't have much time to find that off benchmark investment and visit and do all the due diligence and the analysis, then that will help, because they might invest against a subset or a full indice. So that helps get more money from the global pool of investments. And particularly for ESG, one of the big headaches is, what benchmark do you use? Because if exclusions are made, then what are you're working against a benchmark that's a different set of assets. And so we do need some work on certainly creating some better ESG indices for emerging and frontier markets. And I think going back to a point I made earlier about this is, we're on the right track, and we've made a lot of progress in the last few years. We've got new asset classes opening up in green bonds, in social bonds, in sustainable development gold bonds, and they're making progress, and we're going to get more of those, I hope. But there's still, it's very expensive for frontier markets to borrow, and when I break a price down, you have I don't know, if we take a frontier market that's 750 basis points spread across above US Treasury, so that we're sort of looking at yields and costs of borrowing of 8-9%, and that's huge. And in that, we're talking about greeniums in developed markets of 20-40 basis points, but they're just too small to make a difference. So I think in the price, in terms of lowering the cost of borrowing so that it is affordable for emerging market and frontier corporates, is this realm of uncertainty and illiquidity. And that's where the indices will help, and also the information flows will help, because if we can reduce the uncertainty, particularly for investors who haven't got time to analyze 90 sovereigns in depth, or a corporate universe in many hundreds, then they're help to that task with the information flows. And I think that's where the report, the first conclusions, the first remedies, if you like, are about that, helping develop indices, and also ones that recognize momentum, so that we might have a country that has got problems, it's got challenges, but is moving in the right direction, and helping the country identify that progress and market that progress is absolutely massive. And last year I published a book called Where Credit is Due, which was focused on African debt. And in that book I concluded that it will be the countries that can sort of develop a sustainable brand and really market and sell that brand that will do better and will attract the sort of the calmer capital and the less expensive capital. But there's a huge amount of work to do. But this is something I think that Mobilist can start with.
Yeah, no, it's a great point. And what I hear you saying effectively is a kind of dynamic indices. I mean, they highlight the right information, but there's a dynamism to the index and make it more fit for purpose for decision making. So I think it's an excellent point. I think if we're honest, it also requires a receptivity to utilize those indices by investors. So we can adapt them and build them and populate them, but also investors have to be willing to use it in their decision making approach. But it's an excellent point. Sarah, I want to ask on the information asymmetry. You talked in the first part of our conversation how you really roll up your sleeves and you iterate and you help to effectively solve for that with your own resources, as well as working directly with the underlying asset. And can you just give us an example, thinking about what Stuart shared at that issuer level, market level, of how you've successfully done that to be able then to make an investment decision? And do you see any, after you've done it once, whether it's in a particular country or with a particular issuer, are you seeing the benefit of that to then make further investments down the road?
Yeah, so we did a huge piece of work on the solar supply chain and the cotton supply chain last year, which fed through into certain recommendations for questions, and then also coming together across the firm, across regions, to say what kind of answers would we expect, not just from emerging markets, but from developed markets as well, and companies that are operating in specific regions where there's significant risk. And then going back to the companies and saying, okay, well, these are our questions. This is why we have the questions. And it becomes an ongoing process. You're never going to get all the information at first blush. Some of the companies might not have it to hand. They might still be developing some of these policies. And that then opens another conversation to say, okay, well, this is what we think is best practice. How can we work with you? What advice can we give you? What insight can we give you? And then companies that are actually living and breathing and doing this want to talk about it. So you don't tend to get quite a lot of pushback from the companies that have very strong processes. And certainly within the solar supply chain or the cotton supply chain and issues around human rights and forced labor, the companies come back to us and say, well, we can never give you 100% guarantee that it's not there, but we're constantly looking for it. We're 99% sure that we've gone through our suppliers and we've gone through our supply chains, and it is part of our policy of being proactive about trying to eradicate it. That's the kind of open conversation that we want to have. And once you have one conversation with one company, you can also take those findings to another company within the same peer group to say, well, this is what your peers are doing. How are you doing things differently? And it's never wanting to point blame or point a finger, tell somebody they're doing it wrong. It's saying, well, what are you doing and how are you going to improve? How are you going to have an iterative process? Because you can't just one and done things with ESG. It's constant, and the regulation and our perspective on certain things is evolving, is adapting. And you look over the last 18 months and the focus on climate, where I started in this industry over a decade ago, and I had a hard time convincing colleagues to even look at ESG. What was ESG in some cases? And you'd be on panels and you'd be talking about it and people look like you had another head. And now everybody has adopted that. And it's companies have to catch up too. We've come a long way as an industry, and companies will come a long way as well. And you can't just penalize a company for sitting in a specific country or not necessarily having all the answers at once. It's working with them, and again, not excluding a company because it fails an MSCI screen. It's saying, well, no, hold on here. You didn't have time to fill out a survey. Let's have a conversation, and how can we help you? And I think you have that two-way dialogue.
I think it's fantastic, Sarah. And it's another aspect of what I think Greg is, the point he's making about indices, this kind of dynamism, this, it is an engagement approach. And so part of it is, in fact, the attitude you're bringing to this, Sarah, if I could play back to you. It's not, you're not looking for a reason to say no, to exclude, to punish. You're actually coming at it saying, I'm hunting for opportunity. And I recognize I'm never going to get 100% certainty that this risk doesn't exist. That's just not realistic. So what are you doing, and what can I do to support you and to understand the context, the reality, the real risk, not my perception of the risk, but the real risk, to be able to get to yes, at the end of this inquiry process. So I think you're really speaking to an attitude, not just the resources you bring, but an approach, which is very, very compelling.
Thank you.
I wanted to ask you both, we've got a question about reputation risk and something familiar to both of you. So, what's your view, approach when you think about emerging markets, frontier markets? And interestingly, the question was a little bit a flip of the typical question, headline risk, what am I worried about? Is there any opportunity, given how we began the conversation on need and opportunity globally and specifically in emerging markets to satisfy the global goals, is there any opportunity to flip it and say, for those investors who are not deploying capital in some of these markets, you have reputational risk? What do you think about that approach, Greg?
I like it, but I think we're a long way off that. We're at the other end at the moment where the focus is risk aversion. The focus is making sure that you avoid pressure on particular issues. And the problem is, you build an ESG framework that's data driven, looking at changes in governance scores and social scores over many years. This isn't high frequency data. This is data, governance scores tend to change over a decade, leave alone months. And suddenly that, a particular country or company appears, there's a Financial Times story, and suddenly, you have to sort of explain to people and clients why you're investing in that, and that's always going to be a challenge, because you can have the quantitative approach, but things can change quite quickly on headlines. And I think while that's there, and while the regulation is getting tougher, I think there will be a time where people will avoid making tough decisions about investing in some frontier countries if the governance isn't very good, or if their environmental record isn't very good. And I think that will be to the detriment of these flows. And I think I would like to get to a situation where you can be running a fund that can show that you're working with momentum, that you're helping a country achieve things relative to the Sustainable Development Goals. But I think we've got a long way to go till we get there. And the exclusionary process will probably dominate for some time.
Okay, thanks. Sarah, your view?
Yeah, no, I think it's frustrating that the exclusionary issue still dominates the conversation, because if we think about the perception of risks, and the World Economic Forum puts out a study every year, they've got the most likely risks and then the most pressing risks. And if you look over the trend over the last decade, it's moved from political or social, economic to being overwhelmingly environmental and social. So infectious diseases, climate change, resource management. And these are the risks that a fairly secular body have perceived are the greatest challenges that our governments are facing. So this is where governments are going to be regulating. And there's a danger that if you don't invest in companies that are on the right side of these risks, that's a significant returns headwind, because those are the companies that are still going to be here in 10, 20, 30, 50 years. The companies on the wrong side of that aren't changing, aren't transforming, that you're going to have a serious returns issue in terms of access to capital markets, but also the profitability of their products. So I think it is a nice way to frame investing in emerging markets and investing in sustainability solutions, but we still have to face that tension around exclusions, and it's moving beyond blanket exclusions to understanding risks in a much more holistic set. So it's not just risk mitigation, but it's opportunity maximization, and risk and opportunity go hand in hand. And you want companies that are addressing both. But when we think about those global risks, health, social, education, access to water, resources, ignoring emerging markets and ignoring companies that have solutions in emerging markets or frontier markets, you're ignoring a huge part of a potentially significant problem that's going to have compound consequences. So we are getting there, and it comes back to the question, it's a very neat way of framing it, but to Greg's point, we're not quite there yet. I think the industry is still finding its feet in terms of what ESG means. And we're still looking at how they can hold us to account, how they can interrogate our processes and make sure that we are doing what we commit to do. And the easiest way to do that is having screens, negative screens. It's a lot harder to prove those positives. It's a lot more sensitive.
Yeah, no, I think, what I hear you both saying though is, because investors in some of the geographies that may be newer to them and farther away from where they happen to be situated will lead with the risk, what you're really both appealing to is, okay, but expand and deepen that risk understanding. If that's what you're going to lead with, fair enough, but there's a way to expand it and deepen it. And coming out of a global pandemic, making people cognizant of that connectivity point, Sarah, that you just teased out, we think that we would be ready to go there. Yeah, no, very fair. Any last comment from either of you of how you can encourage, as Greg framed it, the kind of marginal investor, and we don't mean that in any kind of demeaning way, but I mean a marginal investor who doesn't have access to the same resources that the two of you are bringing to this, how they might be encouraged to move beyond the screens, the benchmarks, other things, just even in terms of their investigation of what's possible, because you both have made, I think, quite a compelling case for being an active investor and looking at these opportunities. But any advice specifically for that investor who has a slightly different position in the market and profile to move out of benchmark land, to move beyond indices and benchmarks? Sarah, anything from you on that one?
For me, it would be, don't start with the negatives, start with the positives. Start with the positives in the areas that you're trying to focus on and companies that are actively addressing those positives. And I'm coming at this from an impact ESG lens, which is the focus of my funds. But if you start with the positives and then you work through and go down and do the due diligence, it might mean that some of those indices or the negative exclusions will rule out certain companies, but you have a better chance of focusing on of capturing companies that are actively solving some of these solutions by focusing on the positives first and then applying your negative screens. I don't go about it the other way around, or you're going to exclude most of the emerging markets and most of the frontier markets.
Fantastic, fantastic. So yeah, you're not saying don't ignore the screens. They're there, we get it, and they're going to be tools that you have to use. But if you use it as a starting point, you've narrowed the aperture of opportunity such that you won't get out of the gate. You just won't get there. No, that makes complete sense. And Greg, anything to you about the utility or not of benchmarks? You made the point that moving beyond having more flexibility, but how do you exercise? How do you get to that place? If I haven't done that before, how do I get to that place? Any suggestions for the investor?
For the investor, it's probably to go to if they're the asset owner, fine. If they're an asset manager, to go to their client base, and it's building a case that we should invest in these countries because there are developmental needs, there are climate adaptation needs, there is people live in these countries and we should help those governments achieve the sustainable development goals. So it's articulating that well, so that there's the interest in the buy-in for the fund to then add that to their mandate. So we've got a lot of work to do there. I think people would just invest their pension, and now they're thinking about investing their pension in a way that doesn't pollute. But if we can go a step further now and encourage people to invest their pension in a way that doesn't pollute, but also looks to solve some social problems in frontier markets, then wonderful. And I think that will help and make the capital more patient. So I think that's there. And but in the short term, I think just data quality and frequency comes up in the report many times, and I think you can't go wrong pursuing that agenda.
Okay, no, fair enough. And I like your point about, step by step, right? Sometimes I think when we try to overreach, we also get stuck, and it leads to inaction because it's just too far from where we're the starting point. So that's a good reminder, despite the urgency and patience we all feel in this conversation. So I want to give you each a last word before we wrap up. So as you reflect on the conversation and what Stuart shared, is there any kind of near-term suggestion or action you would encourage or invite among the audience, specifically those who are listening in as allocators? Greg, I might start with you and then give Sarah a chance. You've spoken to a lot in the course of the conversation, but anything you just want to emphasize as we close out?
Look and seek progress, and whether it's adapt your scores for low per capita income, adapt your scores for climate for countries that have never emitted any or very little greenhouse gases in their entire history. So reward countries where you can for making progress or having not contributed to this climate emergency. I think would help for a just transition.
Fantastic. Thanks so much. And Sarah, over to you.
I think for me, it would be context is king. Don't ever look at a company outside its context. And that will be country, that'll be region. Don't judge an emerging market company by European standards, but look to see where you can make a difference and where you can investigate and seek out some of those truths rather than focusing simply on screening. So avoid screening as a starting point. Focus on context, a bit to what Greg was saying, focusing on countries with unmet need and companies that are offering innovative solutions, and have that be your starting point. And I think we'll get a lot further in allocating more capital towards emerging markets if we take that positive stance rather than coming at it from a negative exclusionary point of view.
Fantastic. Thank you both. That was terrific. And to Stuart for the tremendous research and framing of the conversation. And I do want to mention that the research that Stuart shared from Intellidex, and I should mention that Lion's Head has also been a partner in the research agenda of Mobilist, is the first published piece of research under the Mobilist research agenda, but it's the first of what will be a series. And certainly the expectation of the Mobilist team is that these research findings, as it has done today, will be an input to shaping the conversation, and most importantly, to leading to action and deploying more capital to emerging and developing markets. As I alluded to at the beginning, Mobilist has a particular focus on public markets, listed products, but I think, as you heard from the conversation today, a lot of the insights and lessons apply across asset classes. And I think that's also quite exciting when we think about moving money into emerging and frontier markets. Sarah and Greg, it was just fantastic, your insights. We were hunting for actionable insights, and you both have just demonstrated through your conversation today that you are not sitting still. You are very active investors, thoughtful, smart, creative. You understand, obviously, all of the challenges that people point to, but you're demonstrating that it is absolutely possible to come up with strategies to deploy capital and to continue to expand that capital flow in markets. And I really love both of your closing comments, Greg. It's a dynamic, moving process, and there are positive trends. There are positive signals that we can identify and build on, and nothing gives investors more confidence than both the certainty that she's talked about, but momentum. And you really spoke to momentum and the power of momentum. And Sarah, you with context matters. And I think people on this, we have a number of people who joined from lots of different places in the world. And I think we all know from our own experience over the past several years in particular, context and proximity is absolutely critical to understanding how to move money in an effective way. So thank you both. I really learned a lot from the conversation. I'm sure our audience did as well. The slides, the research, I should say, is available. And if you want more information about Mobilist, I think Tara and Chris, your contact details are in the chat. So if people want more information about what the Mobilist program is all about, please feel free to follow up directly with Tara and Chris. But it just leaves me to thank you both, and thanks to the audience. Great questions, great participation, and we look forward to future engagements. The recording of this will also be available on the Impact Investing Institute's website, which I also encourage you to visit. There are some great resources there that relate to this conversation. So thank you all.